this lovely day, we're tackling a key concept for bond investors: the relationship between interest rates and bond prices. It can seem tricky at first, but don't worry. I'll break it down so it makes perfect sense. Let's dive in. Here's the big takeaway: bond prices and interest rates have an inverse relationship. When interest rates go up, bond prices go down. And when interest rates go down, you guessed it, bond prices go up. Think of it like a seesaw. When one side rises, the other falls. But why does this happen? Let's break it down with an example. When you buy a bond, you're lending money to a government or a company, and in return, they pay you interest at a fixed rate. Let's say you buy a bond paying 3% interest. If market interest rates rise to 4%, new bonds offer that higher rate, making your 3% bond less attractive. To sell it, you'd need to lower the price so buyers get a competitive return. Conversely, if market interest rates drop to 2%, your 3% bond becomes more valuable since it offers a better return than the new bonds. Buyers would likely pay a premium for it. To clarify, let's use some numbers. Imagine you buy a bond for $1,000 that pays 5% interest annually. That's $50 per year. Now, if market rates jump to 6%, new bonds pay $60 annually on an $1,000 investment. To make your bond appealing, you'd have to sell it for less, maybe around $900, so the buyer gets a similar yield. But if rates drop to 4%, your 5% bond becomes a hot commodity, and buyers might pay more than $1,000 to get that higher return. That's the inverse relationship in action. So why is this important? If you're investing in bonds, understanding the current interest rate environment is crucial. If rates are expected to rise, the value of existing bonds will likely decrease. And if rates are expected to fall, your bonds could increase in value. To manage this risk, some investors diversify their bond holdings by choosing bonds with different maturities or interest rate sensitivities. This is a strategy called duration management. So there you have it. Interest rates and bond prices are like a seesaw. When one goes up, the other comes down. Understanding this relationship can help you make smarter decisions in the bond market. Keep it simple, stay informed, and you'll navigate the world of bonds like a pro.